Welcome to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Dr. Jack Vogel. Jack is a managing member of Alpha Architect, where he heads the research department and serves as the CFO and co-CIO. His academic background includes experience as an instructor and research assistant at Drexel University in both the finance and mathematics departments, as well as a finance instructor at Villanova University. Jack earned a Ph.D. in finance and a master's in math from Drexel. Today we're going to be discussing his book, Quantitative Momentum, a practitioner's guide to building a momentum-based stock selection system. Dr. Vogel is an expert in asset pricing and behavioral finance. Let's ask him 5 good questions. All right, welcome back to the show, everybody. My guest today is Jack Vogel, author of Quantitative Momentum. Hey, Jack, thanks for taking the time to be with us today.
Yeah, thanks, Jake. Appreciate the offer to be on the podcast. Interesting, excited to share stuff with you.
Well, this should be good because I know Wes has been on the show a few times, so it's exciting to get a little new blood from Alpha Architect.
Yeah.
Let's jump right in. So question number 1, let's start with some basic definitions that seem to trip people up on occasion. What's the difference between growth and momentum strategies? I think sometimes people conflate those two.
Yeah, I'd agree with that assessment. So the basic difference has to do with how the portfolios are formed. So a growth investor is one that invests in securities that have a high price relative to some accounting measure. So, in academics, there's like the book to market measure or the market to book, where you take the market value of the stock and you divide it by the book value. So a growth investor would invest in the basket of securities that has a high market price relative to the book value of assets. Or another multiple that a lot of people use is the price to earnings multiple. So a growth investor would invest in stocks that have a high price relative to the past earnings. So that is growth investing, where you take the current price and divide it by an accounting measure. Now, momentum investing, at least the way we define it in the book and the way a lot of people think of it, has to do completely with the total return or just the price of a security. So in a momentum investor, what they would do is, let's say you have 1,000 stocks, you would rank all of the stocks on their past let's say 1 year total return. And a momentum investor would buy the top 10% or 100 securities that had the highest total return over the past year. So growth has to do with a multiple of price relative to some accounting measure, whereas momentum is purely returns based.
Gotcha. What do you think? Why do you think it is that people get those two confused? Do you think it's just a kind of a laziness, or what's I
think it has to do with the way the industry is just constructed, portfolios and baskets. So if you go on your Vanguard or your iShares or your Morningstar, you're going to see that the universe is split into 9 buckets. On the x-axis, you're going to be splitting the universe by size, so small, medium, large. Mm-hmm. Whereas on the y-axis, they like to split into value, mid, and growth. And the thing, probably one of the reasons they do that is value investing, as we'll talk about in a little bit, is a way of investing that most people like. And value investing is kind of the opposite of growth, where you buy stocks with cheap prices relative to some accounting measure. So momentum doesn't fit nicely on their bucket, and I believe that's probably the reason that just has become institutionalized over the years.
Gotcha. So there's almost a bias against momentum just because it kind of doesn't fit a clean, matrix that is easy to sell.
Yeah, well, there's the existing matrix and momentum's not on there, so yeah, it doesn't fit.
So question number 2, you argue pretty convincingly that value and momentum are potentially cousins, really, and sort of almost two sides of the same behavioral bias coin. First of all, why do you think that's so? But also, maybe follow up with that, why does it seem that value guys in particular seem to be have this bias against momentum investing, is it the same problem where they're kind of conflating momentum and growth? And what most value investors tend to think of themselves as hyper rational, yet this seems to almost fall into a religious kind of zealotry.
Yeah, I'd agree. So let me answer the first part of that question. So when we mention that there are two sides, or actually kind of like the opposite of a coin, right? So with value investing, a typical behavioral explanation for why value stocks historically have outperformed growth stocks is the following. It's that investors are hypersensitive to recent information. So they look at a stock and see recent earnings decline. So you look over the past 5 years, earnings growth is negative in these value stocks. Everyone just kind of assumes that it's going to go to zero. So in that case, investors do what they overreact to recent information. And the same thing happens with growth investing, where investors see great earnings growth rates and they just assume it's going to keep going on forever. So value investing from a behavioral standpoint has to do with investors overreacting to both good and bad news, i.e. for growth stocks, they see incredible growth rates, think it's just going to keep growing like that forever. For value stocks, they see negative, think it's going to bankruptcy. So that's the behavioral story for value investing. Now, the question is, if one believes that an investor may overreact to information, it's reasonable to assume that investors could just as likely underreact to other types of information. Now, price is a form of information because it's the price that people are willing to pay. So in momentum, it's the opposite, where when firms have a little bit of good news that's coming out, people may be unwilling to accept this good news and they underreact to good news, which is why high momentum stocks continue to increase. That's the continuation of returns. Whereas low momentum stocks, they have bad information and people maybe should keep selling them further, but they don't. And then that continues lower. So basically they're the opposites, where value is overreaction and momentum is kind of an underreaction.
So both of them are it's an underreaction to reversion to the mean, really, and then an overreaction to reversion to the mean, missing out on it.
What I'd say is on value, it's an overreaction to reversion to the mean, true. And on momentum, it's an underreaction to new information that comes out.
Okay.
And then your second part of your question had to do with why, to value investors, momentum investing is like the worst thing in the world. So I would guess two ways I think about it. One is value investing is different than momentum investing in the fact that you're looking at accounting measures. You're trying to say, okay, this stock is undervalued given that it's some sort of earnings. Now, a momentum investor doesn't care at all about fundamentals, at least the way we define it in the book. We're simply concerned with the past return of the stock.
Right.
And most people think that's kind of crazy. They're like, well, if I just look at the price of the stock, that should have no impact in the future. So that's one possible explanation. A second has to do with the fact that value investing is really similar, I believe, to the way a lot of people think in everyday life. So, for example, when you get a great deal at a store, or when you get a great deal if you buy a house, everyone has that kind of positive energy, which is kind of like the value investing philosophy, right? You want to feel like you bought a stock that was cheap relative to some measure, just like when you go to a store and you buy your shirt and you get, 50% off and you have a coupon for 30% off, and you're super excited. I think value investing kind of fits more into the way a lot of rational human beings kind of like to justify purchases in their heads.
Yeah. So then with momentum, there's not really a correlation that ties together in the same way, because you don't buy a shirt and then, oh, look, the price of shirts keep going up. Look at how good of a deal I got.
Yeah. I've never heard anyone say that. I bought my shirt for $90. It's $100. It's $95 next year. You don't hear that conversation. You hear, I got the shirt for $30 and it was originally 90.
Right.
So I think it's just the way people think.
Yeah. So question number 3, if you're an index fund investor, passive, which has become more and more popular these days, you're effectively investing in both the value and the growth side of the index.
Yep.
So, but why might be better off if you instead were in what we'll call like a basket of investment of the value side, but then also the momentum side as well, rather than the growth side?
Sure. So what I'd say is historically, just to give context to as to why one may want to not just do value and growth, historically growth stocks, if one just looks, you can go to Ken French's website and take a look. Growth stocks have underperformed the market, right? So initially, obviously, including a basket of securities which historically have underperformed, if you kick them out, you're going to do better. Now, from a portfolio construction standpoint, value stocks and momentum stocks have this effect where if you take out the market beta, i.e. you look at a long-short value portfolio and a long-short momentum portfolio, price momentum portfolio, you see that these two are actually very highly negatively correlated, which is great from portfolio construction theory because ideally one wants the following. In a portfolio, you want to have assets that have positive expected returns, which value momentum historically did, but they also are not correlated because if you put together two assets that are perfectly correlated, you get no diversification benefits. So from a portfolio construction, having value and momentum, which kind of do go up and down at different times, and a good anecdotal story is the internet bubble. So in the internet bubble, momentum stocks for high flying did really well, better than growth. And then in the crash thereafter, value stocks did really well, beat the index by a lot. So combining those two would be good. Now, what I would say, just to before everyone goes and changes their index to a value momentum portfolio, is that the index is built around a value and growth portfolio. So if you decide to switch, you may have tracking error from an index. And if you are an investment advisor, to the extent that your clients may pin you to some index, you just want to be careful before you make a switch.
Right. Yeah. You're taking on some more career risk, let's say, than at that point if you're an advisor.
That's definitely a true fact. So one way you could do that is you make it a smaller portion of the portfolio, or you present the evidence to your clients, and to the extent they want to take a little bit more tracking error risk, you can facilitate that.
Yeah. Well, tracking error also goes to the upside, right? So.
It does, but it's more painful on the downside because, as you point out, for most investment advisors, the biggest issue is the career risk question.
Right.
Just want to make sure someone doesn't make a change without fully understanding there's a potential risk to their own career by doing that.
Yeah, I think I just saw that Vanguard went over $4 trillion in index funds, and I don't think they're going to be moving off of that anytime soon.
That's true. Yes.
So, question number 4: there are a lot of different ways to slice momentum. What criteria do you use to come up with sort of the quality of the momentum? And I assume that really has to do with basically how, like, this input of a momentum number, let's say, whether you're measuring it on different time frames or not, but and then how well does that do from subsequent returns? So how have you kind of sliced momentum? Because there's a million different ways to measure it.
Yeah, so great question. So in our book, The Quantitative Momentum, basically we say, hey, just from a high level, we are going to measure momentum with a 12-month look back, and we ignore the previous month. And one could include the previous month, one could use 9 months, 3 months, 6 months, do a combination of them. That's great. Now, one of the improvements which you ask about here is the quality of momentum. So, and let me just start. So let's assume we have 1,000 stocks. we would use our 12-month look back, excluding the last month, to get down to 100 securities. Now, within those 100, a question has to do with, does it matter how different firms happen to get their momentum? And, in academic research and what we found in our own internal studies is that the answer is yes. And how we measure that has to do with, and again, this is a behavioral bias, deals with the limited attention hypothesis. So I'll give you an example, which I like to use in presentations to try to explain what we're doing here. So imagine we have two stocks that are in our high momentum bucket. There's only two, right? And one of them is called Boring Big Box Store. And Boring Big Box Store, over the past 250 trading days or 200 trading days, is up 50 basis points every day, right? It's like a straight line, which is unrealistic. But for this example, it's the whole idea.
Yeah.
So it's up 50 bips, and so it's up 100%. 200 times 50 bips is 100%. Alternatively, you have stock B, which I'm going to call, exciting biotech, right? And exciting biotech, if you look at its chart, you see it bouncing all around. But then you see, recently, within the past, 60 days, it jumped up 100% in one day. And the question is why? Well, you look and it got an FDA approval. So empirically, the question is, which of the two stores, right, Boring Big Box, which just kind of is a slow grinding stock, or exciting biotech, has future better expected momentum returns? And the evidence shows that it's the boring big box type momentum stocks which one should focus on. And actually, that's where all the premium's driven by. And the behavioral reason has to do with limited attention. And so tying it back to behavior, which stock are you more likely to overlook as a momentum investor, right? It's the boring big box story because there's nothing new about it. It's just kind of grinding along. Whereas exciting biotech had an FDA approval, which caused everyone to read about the company, to correct discounted cash flow analysis, probably price security correctly. So within high momentum stocks, we tend to focus on ones that have a kind of slow grinding return, where investors may have more limited attention.
Yeah,
to that stock.
I like that you called it the boiling frog in one version, and then kind of the lottery ticket in the other version.
Yeah. We call it. The title of the paper is called "Frog in the Pan: Continuous Information and Momentum." And the whole idea is basically, if you put a frog into boiling water, it jumps out, whereas if you put it into a cool bucket of water and slowly heat it, unfortunately, stays in the water. So yeah, it's a good analogy. We can't take credit. That was an academic paper with a good title.
Yeah. How does trend following fit into that and have you found any timing information when it comes to trend following that is actionable?
Yeah. So what I'd say is, and it's a great question. We think of trend following kind of as like a separate thing from security selection for momentum, right? So one could easily implement it. It's similar how you could implement a value security selection side by side with a momentum security selection, right? So we think of trend as kind of like another factor which one could implement in a portfolio. And so is it actionable? I would say yes. What the evidence shows is if you look at, and we have an interesting post on our site about this, where we say, hey, let's look at 12-month trend rules on U.S. stocks, international stocks, REITs, bonds, and commodities. We're just going to apply it. If the trend's positive, we invest. If not, we go to cash. You get risk-free rate. And historically, what you see is you get around 90 to 95% of the return with about half of the drawdown across the asset classes.
The maximum drawdown?
Maximum drawdown,
okay.
Right? So this sounds great. However, I say, there's a couple reasons one may not want to do this. One is there's tax implications potentially to doing that, right? You'd have to sell securities that may have low basis. Second is it causes tracking error, right? So again, we go back to this advisor business where, if you're going to be pinned by your client to the stock market, you probably don't want to be trying to time the stock market. And then the third thing is with trend rules, in general, that they are great, as I mentioned, at kind of trying to and hoping to eliminate the left tail of a distribution by eliminating the maximum drawdown. However, there are the painful events where you get out of an asset class and then it whipsaws back up. And so recently that's happened to us in the U.S. stock market in late 2015 and early 2016. So because we use trend for some of our client accounts, and fortunately we had to explain and say, yes, the reason we're using them, as we discussed, is we want to cut the tails off. And this is the pain that is occasionally associated with adding such a factor.
Yeah. So if you end up with the Fed, being that value investor of last resort, you end up missing the trend. Is probably not going to be your friend then at that point.
Yeah, possibly. Exactly. So whipsaws occur. So again, anytime you do anything different than the index, like value investing, momentum investing, and then trend. So, when we actually do all three, you want to make sure you can fully explain what you're doing, why you're doing it, when it underperforms, as well as when it does well.
Right. So question number 5, for a concentrated value investor who's maybe picking individual securities, can momentum be a factor in that? Let's say I have stock A and stock B, and all else equal, one of them has, let's say, greater relative strength. Would that be maybe a checklist item for my investment checklist, and I might skew towards the relative strength one? Or is it not really effective on that small of a scale, and we need to be much more diversified to really capture the benefits of momentum?
Yeah, so what I'd say is the following. First off, in general, I'd always highly recommend, 25 to 30 stock portfolio minimum, just because really, you do add some idiosyncratic risk, i.e. firm-specific risk, if you go down below that number, right? At 25 to 30, you can eliminate firm risk of someone, the CEO who's the visionary, who really is the person that runs the show, happens to pass away and the firm just drops off, which can happen. So in general, with that caveat, right, and I do understand there are some value investors who like to get onto a 1-2 stock portfolio. What I'd say is adding momentum as a secondary screen to value can be beneficial, 100%. Now, a couple things. One is, depends on the hold period. So momentum is a factor which is very beneficial. However, it does require turnover. So if one wanted to say, hey, I'm going to look at, my 50 value stocks and I want to buy 25. If you wanted to split them on momentum, historically that actually would be a decent strategy. What I'd recommend is you probably have to rebalance it at least annually. Quarterly would be more beneficial. And so, yes, momentum can be used as a secondary screen to value. So what do? We actually, because we know the evidence and momentum is good, we use what we call quality or operational momentum. And the main reason we do that is, again, we run our standalone momentum portfolio. And if you add momentum in value, when you combine the two, you actually increase correlation. So you're kind of losing some overall portfolio diversification benefit. But
so do you take the highest value ones on their own and the highest momentum on their own and make like 50-50 then?
That's how we allocate client assets
to get more diversification, and less correlation between them.
Exactly. But if you said, hey, I can get 2 pieces of information, all the PE variables for every firm and their total 12-month return, which are value momentum, and you do cheap stocks and split on momentum, yes, that's a good split of value stocks. It does work, but then you do have to rebalance it. You can't just let that ride forever.
What happens? Why is that? Is it due to the information bias kind of decays over longer periods of time?
Well, so remember, going back to our previous conversation, value is kind of this underreaction overreaction. And when that occurs, it can take a lot longer within value, whereas momentum is this underreaction. And that's why for momentum portfolios, it's very important that you rebalance more frequently. So to the extent that you add momentum into a value portfolio, you now have kind of slightly changed rebalance frequency of your value portfolio.
Gotcha. Yeah, that makes sense. So bonus question we always like to ask, and that is for a book recommendation. What do you have for us today, and why is it a good one?
Yeah, so mine is Nudge by Thaler and Cass Sunstein. I read that book like 2-3 years ago, and it's just a book that honestly, I almost in everyday life, I think about all decisions, placement of items in rooms, as well as even more major decisions where it helps you to think about the way I guess that individuals interact and set up scenarios for outcomes. So I don't know if you've had anyone in the past mention that book.
Not yet, but it's a great one. I mean, the whole idea of choice architecture and how you can manipulate or shape behavior is just fascinating.
Yeah, it really is, and it gives I think it's beneficial for all readers and in almost in all aspects of life. So that's the book I highly recommend and have recommended to like friends and family as a book to just read about human behavior too, and how we are prone to our own biases and decisions can be highly influenced by the original choice architecture as you highlighted.
Exactly. Well, Jack, it was a real pleasure having you on, and thank you very much.
Yeah, appreciate it.
Thanks for watching. I hope you enjoyed this interview. If you'd like to support this author and purchase their book, click here. If you'd like to become a subscriber to 5GQ, click here. And I included a couple other interviews that you might appreciate right here. Thanks. Happy reading.